All right, today we need to talk about a pretty seismic shift in the tech world. I'm talking about one single day when the entire rule book for valuing software companies was basically torn up and thrown out. So let's get right into what went down. Okay, you're gonna wanna remember this date, February 3rd, 2026. Look, this was not just another bad day for the stock market. No, this was a structural earthquake. It was the exact moment when the market's cozy perception of enterprise software, that super safe recurring revenue model everyone loved, well, that perception was just fundamentally shattered. I mean, just look at the immediate impact here. It's a total sea of red. And we're not talking about some small, risky stocks, right? These are the titans of the industry. You've got PayPal, Thomson Reuters, Snowflake, Salesforce, all getting absolutely hammered in just one day. This wasn't a sniper shot, it was a full-on carpet bombing of the entire sector. So to really get a handle on this shockwave, let's zoom in on the epicenter. PayPal. Wow. It plummeted over 20%. We're talking its worst day in years. Now, sure, part of that was a massive earnings miss. That was their own problem. But what it did was act like a giant megaphone, amplifying a much bigger and frankly, more terrifying story that was just starting to play out. So what on earth caused all this chaos? You have to understand, this wasn't just random market jitters. Nope. This was a direct reaction to a very, very specific technological threat. Let's unpack the real catalyst that sparked this multi-billion-dollar fire. And here it is. This was the spark. An AI startup, Anthropic, comes out and announces that its AI assistant, Claude Cowork, can now handle complex legal work, stuff like reviewing contracts, drafting documents. Now, to you and me, that might sound like a cool new feature, but to the market? Oh no. They saw it as a direct declaration of war on the entire software application layer. And that really gets to the heart of what the market was so afraid of. It's this concept called disintermediation. It's a fancy word, but all it really means is cutting out the middleman. The big fear was that these new AI agents could just talk directly to a company's data and do the work themselves. And if that happens, what happens to all those expensive specialized software subscriptions? They become totally redundant. It begs the question, right? Why would you pay for the tool when the AI is the tool? This right here, this captures the huge psychological shift that happened like overnight. For years, the thinking was pretty simple. AI models are tools. They're things that software companies will use to make their products better. But the new fear, the one that caused the panic, it was that AI models are now the competitors, ready to literally eat the lunch of the very companies they were supposed to be helping. Okay, so let's dig into the specific casualties of this crash. How did this brand new reality really affect some of the biggest names in the business? Yeah, we're back to PayPal because their situation was just a perfect storm. That brutal 20% drop wasn't just about the AI threat looming over everyone. It was also hit with weak guidance for the future and bam, the sudden departure of their CEO. It was a massive signal to the market. In this new environment, any sign of internal weakness could be absolutely fatal. And listen, even mighty Microsoft wasn't immune to this. Get this, they were spending a mind-boggling $37.5 billion in one single quarter on what they're calling AI factories. But, and this is a huge but, at the very same time, they're telling investors that growth in Azure, their key cloud business, is actually slowing down. So naturally, the market starts asking a really tough question. Okay, when is all this insane spending actually going to pay off? And then you've got Salesforce. Their stock hits a 52-week low. Now, for months, they'd been talking up their big AI strategy. They called it Agent Force. But on this particular day, the market just lost its nerve. Investors suddenly became super skeptical. Could Salesforce really turn all those fancy AI buzzwords into actual, real profit fast enough to justify its massive valuation? The answer from the market was a resounding no. Now, Snowflake. This is a really fascinating case. Their stock plunged over 10%. Okay, but here's the wild part. It happened on the exact same day they announced a massive $200 million deal with OpenAI. So what does that tell you? It shows that even a huge, prestigious partnership couldn't hide the market's deeper fear, which was that Snowflake's famous growth rate was, well, melting away in the face of new competitors built on AI from the ground up. But here's the thing. This story isn't all about loss and destruction. Amidst all that carnage, a great divide was starting to form. Because you see, not everyone got crushed. In fact, one company did the complete opposite. Just let that sink in for a second. On a day of absolute, total panic for the software industry, with billions of dollars just vanishing, one company wasn't just holding on, it was actually surging ahead. And that company? Palantir Technologies, up almost 7%. Now, this was no fluke. Palantir's performance was so strong because it revealed the market's new way of thinking. They came out with a strong AI revenue forecast that actually lived up to the massive hype. So why Palantir? What was so special about them? Well, this quote from the investment bank William Blair just nails it. They called Palantir a leader in the AI supply chain. You see, the market suddenly didn't care about the shiny software app you see on the surface. It wanted the picks and shovels. It wanted the guts, the fundamental infrastructure that makes all this AI stuff actually work. And that's exactly what Palantir was seen as. And this all brings us to the bigger picture here. What happened on February 3rd wasn't just some market correction. No, it was the starting pistol for a whole new age, the agentic era. An era where AI agents start to act on their own, autonomously. And that represents a permanent, fundamental shift in how we build, how we sell, and how we value technology itself. And if you want to see where the money's going, this Gartner chart tells the whole story. Just look at that massive growth spike, over 31% in data center systems. That's the hardware, the servers, the guts of AI. Now compare that to software at just under 15%. I mean, sure, it's still growing, but all the real energy, the big money, the excitement, it's all shifting down to that foundational layer. And don't think this is just something happening in the public stock market. Check out this quote from the president of Blackstone. We're talking one of the biggest investment firms on the planet. They now require that every single investment memo they write has to address AI risk on the first 2 pages. That tells you everything. The private money is just as worried about AI turning today's darlings into tomorrow's dinosaurs. So the takeaway here is pretty stark. The market has moved on. The golden age of SaaS, that time when any company with recurring revenue got a sky-high valuation, yeah, that party is officially over. We are now in a selection phase. Just having software isn't good enough anymore. Investors want to see, no, they demand to see, a clear, defensible position in the new AI supply chain. And all of this leaves us with one final, absolutely critical question. In this new era of agentic AI, as these autonomous agents get smarter and more powerful, who actually has a defensible business? Who is going to build the next great software company? And which of today's giants are simply going to become a feature, just a button inside a much larger AI model? That right there is the multi-trillion-dollar question the entire tech industry is grappling with right now.